Hi everyone, I'm Kyle Bechet, and this is the AAF Exchange, a podcast from the American Action Forum, where experts provide clear, data-driven insights into today's economic and domestic policy issues. Welcome, and thank you for tuning in. On this episode of the AAF Exchange, congressional leaders and President Biden make a little progress on the debt limit, the latest read on the economy, and the Inflation Reduction Act's sweeping changes to Medicare Part D. Joining us to discuss all of this is AAF President Douglas Holtz-Eakin. Doug, thanks for joining us.
Glad to be here, Kyle.
How have things been?
Things are great.
Yeah.
You
were on Fox Business just a little while ago. I feel like it's a busy day for you.
I'm going to do a lot of talking. Just yak from beginning to end.
Yeah, well. So let's start what we usually do with your reaction. Tell us what's on your mind.
Well, as you know, since you're around the office and around the production of the Daily Dish, I've had it with Congress and drug pricing. I really have. We're going to talk more about the Inflation Reduction Act. But in general, when this whole debate started, let's just roll the clock back to, say, 2018, 2019, it was true that we did not in general have a drug pricing problem. We had some real select pockets of problems. Oncology drugs and other specialty drugs, super expensive, that was an issue. And some generics, sole source generics, people were buying them up, jacking up the price by 150%. That's a problem. But we don't have a problem with every drug price. Congress continues to pretend we have a problem with every drug price and to do broad-based, one-size-fits-all things. And the Commerce Committee, the Health Committee, and the Senate Finance Committee are all at it again. So I would like them all to just stop.
Yeah, that was a particularly fun dish to read this morning. I'll say that. I would highly recommend anybody who hasn't read it yet to go take a look at it. Anyways, let's move on and talk. We'll like you mentioned, we'll talk about some more on that later in the show. But let's start with the big news of the week. Congressional leaders on Tuesday met with President Biden at the White House. They said that they're going to do it again tomorrow, Friday. The general consensus is that, they spun their wheels trying to strike a deal. Where do things stand on this?
I think the meeting was on net a positive.
Yeah.
And I think it was positive for two reasons. Number one, they agreed to meet again tomorrow, and they sent the staffs off to meet in the interim, so work is being done. The president sat down with the press and said that unspent COVID money is on the table. If something's on the table, it means you're negotiating. And that's what's been missing, any attempt to negotiate, because when you take all the theatrics out, in the end, you need a bill that can pass the House, pass the Senate, and be signed by the president. The bill that came out of the House can't pass the Senate. But the Senate usually just picks up the House-passed bill, amends it as needed to get it through the Senate. A White House that's paying attention tries to make sure that those amendments are things that the president's willing to sign off on. Mm-hmm. And in this circumstance, it has to go through the House and time's of the essence. So keep track of what the Speaker's wish list is and make sure that that bill actually is acceptable to House Republicans. Okay, that's called passing legislation. That's what all of them are supposed to do. Go do your job.
Right.
It's that simple.
It really does seem like we're finally past the theatrics part of this. We're part of, we're a few weeks away, and we'll talk about the X date in a second here. But as you mentioned, things are on the table, which means you are negotiating.
Yeah.
What are they talking about in terms of what's on the table?
I don't know. And we're probably not going to know. And I don't think that's a bad thing. Mm-hmm. They're going to sit in the room and float ideas, some of which will be just utterly non-starters with the other side. And there's no need to sort of publish the list in advance and sort of gin up opposition to things. Sit and make a deal. And then everyone is going to end up with a bill that is not their wish list, that no one's going to be entirely satisfied with it. Everyone's going to have to go back to their respective constituencies and sell this bill as not perfect, but acceptable.
Right.
So that's the process, and it is actually best done between the principals, and I hope they'll do it tomorrow.
And as you mentioned, on Fox Business this morning, it is the White House that has to drive this bipartisan legislation a lot, and hopefully that's what's going to continue to happen tomorrow on Friday.
Yeah, and that's my view of how effective bipartisan legislation gets crafted. The White House has to take a lead role because they're the only entity in our system that's positioned to broker agreement across the House and the Senate.
Right.
They can't do that on their own, and they certainly have the power to take Democrats who might not be too happy about things and do things for them. They can raise money for their reelect. They can campaign for them. They can get them to take a vote they otherwise don't like. That's life.
Right. What about this X state? I mean, we've heard a lot of talk about it. Earlier in the year, it was, maybe August. We had until August, maybe September. Now the Treasury is really saying that we have until June to get this done. What is this X date, and how are they figuring this out?
So the X date is the day on which the Treasury runs out of room to maneuver using the so-called special procedures that they've been basically taking bonds out of government pension funds. That puts them under the limit temporarily. They sell new bonds to the public, puts them back up at the limit. They use that cash to pay the bills. So this is all about cash flow. What's coming in and what's going out. What's going out hasn't changed very much, but what's coming in has dropped off dramatically from earlier in the year. We're running about $150 billion below CBO forecasts on the revenue front. So the cash flow in the first part of the year has been a lot less than anticipated. That means they've been using up their capacity through extraordinary measures, and the X date now is considered to be June 1st as opposed to getting all the way to August. The big thing that happened was April 15th was weak. They thought April 15th would be strong enough to get to June 15th, which is a quarterly tax payment for especially big corporations. Because it was weak, now we can't get to June 15th, so we can't get to August.
And just for April 15th was tax day when Americans paid their taxes.
It was actually April 18th this year.
Right,
but, you know, that's life. But,
we don't pay taxes on weekends, right?
Right, or Mondays that are holidays. So we push the city back even further. But so that's why there's a sudden urgency. The X date, I think everyone really thought was going to be in August. Suddenly it's June. They have to get moving faster. Good, move fast. It's highly uncertain, so we don't know it's June 1st or June 2nd or June 3rd. All the estimates cluster early in June, so June 1st is a good benchmark for when to be done. Right.
Well, so let's hope that tomorrow yields some good progress on something that can pass the Senate and then pass the House again.
Right. And remember, nothing motivates Congress more than a recess. And the Memorial Day recess is at risk if they don't get a deal done. So forget about a global financial crisis. That's not a motivator.
Yep.
Memorial Day weekend, that'll move votes.
It's always fun with Congress. Let's move on. We got a lot. We'll probably be back here talking again in a few weeks about this. Let's talk about the latest on the economy. We had the April CPI report came out this week. What's your read on that report?
So that report, taken at face value, just looking at the sort of top line, went from 5.0 year over year to 4.9. Core went from 5.6 to 5.5. So sort of not much going on. Food, energy, and shelter, my favorite bugaboos, some from 6.4 to 6.3. So no dramatic relief on the inflation front, but inside shelter, which I have harped on for quite some time now, for the first time since February of 2021, went down year over year from 8.2 to 8.1. The month of April was actually quite weak. Everyone has been waiting for this to happen because the leases have been signed at much lower rates of inflation. They're now starting to show up in the CPI. So one can anticipate that is really good news for the future core, the future services sector inflation, which is everything. And I think it opens the door for the Fed to pause in June. This is what they've been looking for. Pausing doesn't mean that suddenly the Fed's gone soft. If they keep rates the same and inflation comes down, real interest rates are rising as that happens. So monetary policies can continue to get more restrictive. We know they're tightening credit standards out in the economy in the aftermath of the banking difficulties. So the combination of tighter lending standards and high real rates will continue to be a downward pressure on inflation, and that's what the Fed wants: continued restrictive monetary policy.
Yeah, I was going to ask you. That was going to be you got on my next question about the Fed a little bit, but yeah, I mean, it seems like they gave themselves enough wiggle room in their last report that we just got, or their last increase where they increased by 25 basis points, but in their minutes talking about how, or in Chair Powell's report talking about how they'll look and see what's going to happen, and this report might give them that leeway to stop them from an increase.
I think it does. I had anticipated this might come in stronger. We wouldn't see the shelter price be quite as weak as it was, and that they would raise again in June. But I don't think that now. I think they're data dependent. I think we should be too. Respect the data. The data are coming in softer, and that's what they've been looking for. They'll get another CPI report just before the June meeting, but I don't think it's going to mean as much because they like to telegraph what they're doing. So they're going to huddle, having gotten yesterday's CPI, today's producer price index, which again looks just the same, sort of more the same on the core PPI, so no big change in things. I think they'll huddle and decide they have room to pause, and they will. And that's the message they'll send over the next couple of weeks.
Yeah, one of the big things I've been hearing, on social media, on the airwaves and what have you, is that this was finally, we got a report as what they expected. It came in as expected. So that seems to be everyone taking not quite the biggest sigh of relief, but okay, we understand this. We understand what's happening in the economy, and we can make decisions. We can make better decisions now.
Because it came in as expected, we now get to gauge something about the open market committee itself, and what's the division between the hawks and doves. Everything's been unanimous so far. There hasn't been a single dissent. It's not hard for me to imagine someone who was inclined to keep raising, looking at this and saying, "There's not much of a change. Let's keep raising," and trying to make that argument at the meeting. So we'll see. It's going to be interesting.
Ooh, that'll be something that we'll have to keep an eye on and bring back.
There's rates and there's economic growth, but food fights at the FOMC, that's fun.
That is what will pick our viewership up in the next one. But all right, let's put aside the economy and go to my favorite point in the podcast. Your favorite point. I know.
Yes.
Call it the fact of the day
segment. We'll have to make up some number. The answer is 9.
Well, it's not a numerical answer, so you're already wrong.
Oh.
So, which agency recently proposed rule will have an upfront cost of roughly $39 billion? And we're looking for the agency.
The agency that just proposed a rule.
Yeah, proposed rule, not enacted rule, of $39 billion. It was one of the fact of the days this week in the Daily Dish.
Oh my. How did I miss this? This could be the tailpipe rule. It came out of EPA.
It is the EPA tailpipe heavy-duty Phase 3 rule that just came out. So, I mean, it seems like the Biden administration is pushing full speed ahead.
More today. Today's the power plant rule.
Today's the power plant rule, so we're going to even more.
You'll get a bigger number there.
Number. So what do you? I mean, it seems like that at a time when small businesses are going to be under pressure with rising interest rates, that it would be the right time to pause on some of these costly regulations, but it doesn't seem to be the case.
So, what the Biden administration would answer is, we've done a benefit cost analysis of all these rules, and the benefits exceed the costs. You're all concerned about these costs, but we're interested in the benefits, particularly the climate benefits, and they've made this case continuously. I think they underestimate the impact on growth in the economy. This was a pattern that occurred in the Obama administration when we were trying to come out of the Great Recession, we're just struggling to get decent growth and employment, and they were adding well over $100 billion a year in regulatory costs. This administration's double that. If you're a business complying with these regs, it costs money, and all you can do is raise your prices. And so at a time when the Fed's trying to push down inflation, this is pushing it up. The sort of collision of those two forces, it hurts economic growth. And, in the second half of this year, the Fed staff has already forecast recession. Most private sector forecasters are worried about a downturn. Doesn't seem like the right moment to do more of that.
Right. Yeah, I mean, it's one of my favorite parts of the Weekend Regs right now is sort of that 3-chart comparison of comparing the 3 administrations since the Reg Rodeo started tracking a lot of this stuff is the amount that the Biden administration has exceeded both the Obama and the Trump administration.
It's just stunning. And they don't have more regulations. If you look, the Obama era had more total regs, but the cost per regulation is extraordinary. It's twice as high as the Obama years.
Wow, that is extraordinary, and I mean maybe even more to come with their their changes to their expected changes that we're talking about back in January of 2021 when they made the changes about how they were going to do that cost benefit analysis that is now in place.
Probably the biggest thing there is going to be the lower discount rate, which allows you to take these upfront costs, the $39 billion, but count benefits in the future much more highly because you're not discounting them as much, and that more rules will pass the test.
Interesting. All right, let's end with the Inflation Reduction Act. This was passed in the last Congress, but it's coming back up. You had I think a pretty interesting insight earlier this week on what some people might have missed with its impact on the Medicare Part D section, and by extension on seniors. What effect will the law have on this program? What did you find in that?
So most of the focus has been on the price controls and that part of the bill. Put that aside. The law also changed the structure of the Part D benefit. The standard benefit used to have an upfront deductible, like most insurance policies, and then had a 20% co-insurance for a while. Then there was this famous donut hole. And the donut hole a while back got filled in large part by money from the manufacturers. And then you hit a, quote, catastrophic part, but there was always 5% that the beneficiary paid as far as the eye could see. And what they did in the Inflation Reduction Act is they just said, okay, we're going to have the insurance plans on the hook for a lot more money. They're going to have 60% on what's going on in the donut hole. When we get to the catastrophic, there's going to be no out-of-pocket exposure to the beneficiary. There really is a maximum that they're going to pay. Past that, then, someone's got to pick up the tab. Used to be the government picking up 80%. They're going to flip that over to the plans in large part as well. So they're going to be on the hook for roughly $40 billion more per year than they would have under the old design. Now, collectively, plans have profits of about $4 billion, so they're not going to be able to just eat the $40 billion. They're going to have to react to to this cost that they now face. And the question is, what will happen to premiums? They could charge more to beneficiaries. What will happen to the prices they negotiate with manufacturers? It'd be great if they could negotiate $40 billion of lower prices. That'd be fantastic. What's going to happen to sort of how you design your plans, like the formularies? They're going to try to modify that so that people are using less expensive drugs, not going to the catastrophic. What are they going to do with the number of plans? There are two kinds of plans: Part D standalone plans, and then Medicare Advantage plans, which are broad insurance contracts that include the drugs. How's that going to change? And then, there's things called utilization management, but that's things like prior authorization. You go, and the doctor has to get an authorization from the insurance company before they can prescribe a particular drug. All that's meant to reduce the use of drugs and reduce their costs. Every one of those things is at some level bad news for beneficiaries, right? The plan you used to have is now gone. The formulary is not what it used to be, unless they negotiate lower drug prices, which would be great, but I don't think they can do all that. Utilization management's a nuisance at best. And then you've got the potential of higher premiums, which have historically been a lightning rod in the Part D program. People don't like higher premiums. Yeah. So I just wanted to highlight that this is a program that's been enormously successful and has great ratings by its participants. Like well over 85% of seniors are extremely happy with their Part D experience.
85% of seniors.
So you just don't get that in a lot of things. I'm curious whether that's at risk.
Yeah, I mean, what was this something that was just overlooked? Why you mentioned in your piece that
like a lot of it I think is good. Right, so the original design of Part D harnessed the power of negotiation between manufacturers and plans. The whole idea was give these plans a reason to negotiate. So if you have to hold your premium down, got to get drug prices down, and you wanted that. Over the years, they had put more of the burden on the manufacturers to fill the donut hole, and they had sort of weakened the negotiating incentives. This strengthens them dramatically. They have to keep people from getting to the catastrophic region, so manage their use and get lower prices. Stay out of the catastrophic region, again, get lower prices. So that's all good. The question is just, will it happen without disrupting the beneficiary experience too much?
Interesting. Well, Doug, thanks for breaking that down. And you know what? I want to end on a quick note that I'm very surprised that we've made it through 3 podcasts, or 2 to 3 podcasts now, without bringing up sports, when you have so much ammunition against me right now, where my teams have completely collapsed.
Your teams are still playing? Because I didn't see anything that looked interesting.
You know, people have been being, my friends.
There's some guys in green jerseys out there in the NBA playoffs, so I don't know who they are.
Yeah, they're not the Celtics. They're not the Celtics that I watched all year, and those were definitely not the Bruins I watched all year. So, I just had to, commend you a little bit for not bringing that up, because I wouldn't be able to hold back. I know that.
Well, let's see. Pittsburgh has a pro basketball team? No.
No, true.
The Penguins are in the playoffs?
No.
Conversation over? Yes.
All right, Doug, thanks again for joining us and talking about all these things.
Bet.
I hope you enjoyed this conversation. Tune back in for our next episode, where our experts will provide clear, data-driven insights into today's economic and domestic issues. I'd also encourage you to check out any of the links in our show notes, and also follow us on social media to learn more about AAF. Don't forget to subscribe on iTunes, Spotify, or Google Play.